Welcome to our market update for June 2024. So today's video, we're going to touch on the key investment themes as well as our preferred exposures at the moment. So firstly, just thinking about leading indicators for future economic growth. What we've seen in the last sort of 6 to 12 months is that those indicators have rebounded off their lows, which is good for economic growth and also corporate earnings going forward. However, the recent data prints on some of those indicators has actually been a little bit weaker. So we expect that's going to lead to more volatility and dispersion between winning sectors and underperforming sectors. Second point I'd make is that the structural growth trends that we've seen in place for the last few years still remain strong. That's in areas like technology, communications, and healthcare, and that has implications for our international equity exposures. On inflation and rates, what we've seen is that inflation and rates have both moved a lot higher in the last few years. And in the last 6 to 12 months, those rates of inflation have come down. However, they still remain too high and certainly above central bank target levels. So what that means is that interest rates are likely to remain kind of around where they sit, particularly here in Australia. And we think that the last mile of getting inflation down is going to take some time. So I think we just need to be a little bit patient as investors there. We've talked a bit about fixed income in the past, delivering attractive risk-free, or not risk-free, but risk-adjusted returns. That's particularly pertinent for income-seeking investors. So we'll talk a little bit about how that fits in vis-a-vis Aussie equities. In terms of commodities, we think the energy transition that's going on at the moment all around the world does support greater investment in commodities, particularly copper, which is used for electricity transmission as well as renewable generation. So we'll talk a little bit about that theme. In terms of quality companies, listeners would have heard us talking a lot about these types of businesses in the past. They remain a cornerstone of our portfolios, and we've added a couple of those new quality companies to our portfolios recently. So we'll talk a bit about Roche and Hub24. And finally, small caps. We've talked about that in the past as well, but the thesis there really is that small caps relative to large caps are attractively valued, and we think can perform quite well going forward. So just in terms of looking at the growth indicators that we talked about, what we're really talking about is the purchasing manager indices as well as new order levels relative to inventories, and you can see on the left two charts that those two have trended nicely off their lows from around January of this year. However, the last couple of months we've seen a deterioration in those surveys and indicators. So simply put, that just means that it's a reflection of a slowdown in orders, which is a function of greater uncertainty by businesses, and that a lot of that's being fed by the fact that interest rates and inflation are weighing on sentiment at the consumer level, and that's kind of feeding through to businesses as well. So it's not a case of rapid economic growth or expansion by any means, and so what that means is we just need to be more selective about portfolio positioning. We need to have a good balance between structural growth opportunities as well as defensives, and then the portfolio ballast remains those sort of fixed income investments that we've talked about. In terms of long-term investment trends, I think it's often distracting to look at the short term, and we try and look at longer term themes and trends. And two of those trends that we see in the market are clean energy or the energy transition, and the second one being the reshoring of manufacturing supply chains, both of which will mean much larger levels of capital investment, and that's obviously going to affect a whole lot of different types of sectors and companies. So we'll talk a little bit more about that as it pertains to commodities shortly. As I touched on inflation, the last mile we think is going to take a while to get down, and that's really a function of the fact that when rents and wages go up, they tend not to go down, and so that simply means that inflation and rates are probably going to, in the short term anyway, be elevated. So that has implications for our fixed income investments that have exposure to those higher levels of interest rates, and so that's a good thing if you are a fixed income investor. And then just in terms of what interest rates look like going forward, you can see in the US that the cash rates sit between 5.25 and 5.5% currently, and that is expected to come down towards that sort of 4% mark over the next 12 to 24 months. If we contrast that with Australia, our cash rates haven't got as high as the US. We've only lifted rates to 4.35% as it stands, and the outlook for those cash rates is more or less that they'll remain on hold over the course of 2024, and then the market is pricing in modest interest rate cuts in 2025, but all of that is data dependent, specifically data dependent on the path of inflation. Let's get on to the asset class insights, and specifically the equities asset class. So thinking about international equities, we've talked about this and we've showed this graph in the past, but basically what we're looking at is the S&P 500 index in blue, and we are looking in orange at the earnings per share for those companies. Over the last 12 months, the US has performed really well, and that has been a function of stronger earnings growth, particularly from the big technology companies and communications companies, the companies like NVIDIA, Alphabet, Microsoft, and the like. And recent reporting continues to support the view that those earnings growth rates and trends are likely to be persistently strong over the next few years, given the significant investments in areas like artificial intelligence and cloud computing. In terms of valuations, we're always conscious of the price that we're paying for investments, and specifically we're looking at the price earnings ratio for the S&P 500. What you can see is that the PE ratio for the S&P has expanded from about 18 times 12 months ago to about 21 times today. So whilst it has increased, that is a sign that investor sentiment has lifted and got more exuberant. The main point that we want to focus on and highlight on is the fact that earnings per share is the key driver for the S&P 500 over the last 12 months. Our attention now to Australian equities. So same chart as we were looking at for the international equities. So we've got in blue, we've got the ASX 200 price index. In orange, we have the earnings per share for that same index. What you can see is over the last 12 months or so, earnings have deteriorated for the ASX 200, whereas the actual share prices themselves have actually gone higher. So that has resulted in valuation multiples expanding from around about 14.5 times to nearly 17 times. So there's been a material increase in the valuation multiple for the Australian share market, whereas earnings, so as I've just touched on, have deteriorated. So that's not a great setup. The other thing that we often talk about with Australian equities is the favourable income that they do provide, and that's a function of the fact that we have a franking credit system here in Australia. Now, that's all well and good in isolation. However, what we've seen, as we've talked about with fixed income and cash rates, is that those rates have actually gone up. So the relative attractiveness of equity dividends compared with bond investments or fixed income investments, or cash for that matter, has actually deteriorated, and that's kind of shown on that right-hand graphic, which just shows the dividend yield of the Australian equity market relative to the government bond yield. So if you are an income-seeking investor, Australian equities do provide you that favourable franking dividend stream. However, you should also consider adding to fixed income, given those yields in fixed income are a lot more attractive than they have been in a long time. Now, we've talked about the energy transition and how that relates to increased demand for certain commodities. And one of those commodities is copper, which is expected to benefit greatly from those increased renewable investments, as well as electricity transmission investments that are taking place all around the world at the moment. And that's evidenced and can be visualized. If we look at the left-hand chart, which just shows the traditional demand for copper, which is just under half of the increased demand over the next 20 years, comes from those traditional sources. And more than half actually comes from the increased investments in electricity networks, electric vehicles and storage, as well as renewable power generation assets. So that's going to certainly be very favorable for the demand side over the next sort of 15 to 20 years. And on the supply side, what we've witnessed over the last 15 years or so is that there just haven't been very many major discoveries of new copper deposits or new sources of copper production. So that simply means that we've got an imbalance there. You've got rising or growing demand and supply, which has been relatively constrained. And the only other point I'd make in terms of on the supply side is the fact that from the very large copper deposits that we've got in production around the world, as those mines go through their reserves, what tends to happen is the ore bodies tend to have lower grade ore as they go deeper. And so what that means is the cost or the operating costs of those mines actually go up over time. So that just means that higher copper prices are required in order to incentivize the production of those lower grade ores in those different ore bodies. Now just turning to a couple of our recent additions to some of our portfolios. Firstly, on the international equity side, we've added a global pharmaceutical business, Roche, which has a very broad portfolio of drug assets, and that portfolio is refreshed annually with a very significant level of research and development, which really supports the future growth pipeline for that company. As I mentioned, it's diversified across different areas. So it's got a lot of drugs in the oncology and cancer space, neurology, hematology, immunology, ophthalmology, and emerging areas in cardiovascular and diabetes treatments, so GLPs being one of those. So that pharmaceutical part of the business is the lion's share of it, and we think that's a relatively high quality and steady source of long-term growth. The other part of the business that we think is a more steady kind of low growth area is the diagnostics, which benefited greatly during COVID through all the testing that Roche undertook for COVID. And over the last few years, as the COVID testing levels have dropped off, that's been a headwind for Roche's earnings growth because they were comparing high levels of earnings growth with lower levels or more normal levels. So that cycling of those high levels of sales has pretty much been completed at the moment. So going forward, that will be less of a headwind, and it'll actually become a bit of a tailwind going forward. Valuation looks really cheap for this stock. The PE multiple is about 12 times. Free cash flow yield's about 7%. And the dividend on this one is about 4.5%. From a growth point of view, the earnings growth isn't rapid. We're not talking about 20 or 30% per annum, but we are talking about high single digits. So you've got a high quality company with a broad portfolio of products coming to market, trading on a cheap valuation and growing its earnings at high single digit levels. So overall, we think that's a pretty good mix. And then the other recent addition we've put into portfolios is actually an Australian equity position. It's an investment wealth management accounting business called Hub24. This business is benefiting from a couple of different drivers. So there's a virtual duopoly at the moment in this space. There's a couple of players. There's Netwealth and there's Hub24. The large incumbent bank-aligned platforms have seen outflows from their platforms over the last decade, as financial and investment advisors have left these bank-aligned businesses and set up their own businesses, independent. And when they do that, they need to then go and find a platform to help them manage their business, and they tend to go to one of either two, which is Hub24 or Netwealth. So that has basically seen Hub24's market share go from about 1% of the market a few years ago to about 7% today. And our expectation is that that's going to continue to grow going forward. And that should support earnings growth of the order of 20 to 30% per annum over the next few years. Return on equity is very good. It's around 15%. Profit margins are very good as well. This one, the valuation isn't what we would classify as being cheap. The PE is 40 times, which is higher than the market, but those earnings growth rates are considerably higher than the market growth, which in Australian equities is close to zero over the next couple of years. So all in all, we actually think this is a great company trading at a fair price and that's why we've added it to our portfolios. So just wrapping up our high conviction views. So firstly, fixed income remains a very attractive source of income and is a diversifier in portfolios. And so that is particularly helpful for investors that are in the pension phase. Two, equities. So structural growth, we talked about some of those trends, and we even talked about Roche today, which is a position that we would consider a defensive, which provides that sort of stabilization within portfolios against macro shocks and volatility. Commodities, really, it's a twofold benefit, being one, an inflation protection mechanism, and two, in the case of copper, having favorable supply demand dynamics, as well as exposure to that renewables and energy transition trend that's taking place. And finally, small caps, we haven't really talked too much about that in today's video, but just to reiterate that we do like small caps for the valuation perspective that they offer relative to large caps. So look, thanks for your attention. Thanks for your interest. If you do have any other questions, reach out to your advisor. You can find more information on our website, or you can send us an email. So we look forward to speaking to you next time.